Hello and welcome back to Fin 340 Real Estate. Today we'll be doing chapters 15 and 16, which deal with taxes, and then titles and closing and escrow. In chapter 15, we have property taxes, and then assessment and appeal, income taxes on the sales of own residence. In chapter 16, we're simply going over escrow and prorating at closing. So in chapter 15, property taxes are the main focus of this chapter, and the whole big deal about property taxes is what they're used for. They're pretty much used to fund all of the major expenditures of local government, so fire and police departments, welfare programs in the local area, public libraries, street maintenance, and the like. Okay, very important source of funds for most local governments. And so it's very important that we understand how to compute these taxes and why they're important. For example, in West Virginia, we have extremely low property taxes, and there is very clearly a reason that we have extremely poor roads. The low property taxes lead to us having not enough funds to repair the roads on a regular basis. And the other thing that occurs from our low property taxes is predominantly low funding for education systems. So West Virginia is well noted in the United States for being one of the lowest funded education departments. And that's due to having low property taxes and low property tax rates. So for example, in Pennsylvania, if you were to buy a home, you may be expecting to pay $3,000 to $4,000 in property taxes per year on about a $200,000 home. In West Virginia, you may pay on a $200,000 home about $1,200 a year, $1,200, which is significantly lower. And again, due to that, we have lower revenues for the state to use for its expenditures and the local governments to do so as well. So, how do property taxes come about? Well, all property taxes are ad valorem taxes, which just means that they're tied to the value of the property that's being taxed. If the value of the property goes up, more taxes applied. If it goes down, less taxes applied. The idea here is that people who can afford more property or more expensive property should also have the ability to pay their taxes. So we charge at the value, ad valorem. And that's basically how all of the taxing system works across the United States for property taxes. How do we determine how much we should calculate in the taxes? Well, the taxing body, which is your legislature, comes up with forms of a budget. That budget is approved, and then we try and fill the need for what is not being provided by other revenue streams, either by the federal government or other property sales, asset item sales the government makes. The rest of that has to come from property taxes or income taxes. What's not met by income taxes, we take the property taxes, and that is split among all of the ownership of land within the district that the taxation is occurring. So we have to figure out what is the value of all the estimated land in this district. This is part of the appraisal process. So some individual goes out and he appraises the property and he creates an appraisal value of that property. And then he goes to the next one and he creates an appraisal value of that property, and then the next one, etc. All along forming a database of all of the value of the properties within the district. We then go and we set the assessed value of the property. So you've got an appraised value, which is what the appraiser thinks the value is at, and then you've got an assessed value. The assessed value really is just what does the taxing department want to make the tax rate basis for this property. So say we appraise the house at $200,000. We may only assess the house at $100,000 of value, which means the tax is going to be computed on $100,000. Now, of course, this doesn't really matter because you just change the tax rate that you're charging on the assessed value to get the numbers that you want. So we could also have made the assessed value $200,000. We just cut the tax rate in half because we've doubled the value of the property. And we would get the same value in the dollars of taxes that we would if we calculated $100,000 and twice the tax rate. Okay? So the assessed value can be either 100% of the property value or less, but again, it doesn't matter. It depends upon the tax rate you charge to float the numbers to where you need them to go. And again, it's going to be computed only so that the needs that have to be filled in the appropriation process by property taxes will be met. No more, no less. So, taxes on the property side are always computed using a mill rate. And this seems a little bit outdated, but it's how it's done. And you will still see today if you get a property tax statement calculated as a mill rate. A mill rate is 1/10 of a cent. Okay, 1/10 of a cent. So a 4% tax rate is expressed as 40 mills, okay, which is simply $4 if you want per $100 of property value. or $40, 40 mils of $1,000 of property values, okay? Mils, milli, meaning thousands. Okay? It doesn't mean millions, it means thousands. So in this matter, the convention, again, outdated, but you'll see it all the time, so it helps to understand what's going on here. And here's a little table from your book. Some school district charges 40 mils, which means per $1,000 of property value, you will pay 40 bucks. So if we have a $100,000 house, that is going to be 100 thousands, so you will end up paying $4,000 of property taxes. In the city, you're going to have 30 mil rate, okay, which is $30 per thousand. And if you again have $100,000, you're going to pay $3,000 into the city. And then it's the county. I have country there. Should probably say county. I don't know what your book says, but we'll fix it later. The county rate is 10 mils, and that is $10 per thousand. You'll pay another $1,000 for that. So in total, you'll pay $8,000 per year to your property taxes. Quite expensive. Tax liens. So after we assess the property tax and we compute it and we apply it to the property, it comes as a tax lien onto the property itself. This lien will remain on the property until that balance is paid. Once the balance on the property is paid, the tax lien is removed and the property can be sold fee simple to the next individual through a deed transfer. If the property tax is not paid, you cannot sell the property, and if you remain not paying it for long enough, the government simply seizes the property. You will lose the property. Then the title is transferred to the state or the county, and it is held for a short period of time. If you do not make substantial payments on the property or make any payments at all, during that period of time, it will go to sheriff's auction in order to reclaim the value of the property. Any surplus proceeds provided by the auction will be returned to you, but the person who purchases and gives the highest deed in the property auction will obtain the value of the property under a tax deed, and they're the highest bidder. So the whole idea here is the government's going to sell your property in order to get their portion of the taxes back. Once they have that, they'll give you the difference in order to return you the value of the property. You generally are not allowed to bid on your own property under the sheriff's auction for property tax deed. That's to keep people from simply not paying their property taxes, having the property come back up on auction, and allowing you to buy it out for a cheaper value and screwing up the tax basis to begin with. Okay, now, because people don't want to pay taxes on their property, they are very concerned about the value of assessments which are placed on the property to begin with. It's really not a happy day if the appraiser comes along to your house and you have been paying only on $50,000 and your house is truly worth $200,000, and they appraise you up to $200,000. Your property tax bill will jump 4 times what it has been in the past. So let's just imagine that you've been paying $1,000 every year. All of a sudden, you've been assessed for $4,000. You can imagine people are not happy. Okay? So they will then go and file an appeal of the assessments. They say, well, it's been only $50,000. Why have you now assessed me at $200,000? That seems like quite a large jump. So they get out these things called assessment rolls. The assessment rolls show the calculations of assessments and appraisals for properties which are near your own and are similar in type to your own. For example, have 3 bedrooms and 2 baths and a kitchen, etc., living room, all the same amenities that yours has, to give you, well, these are the assessments that we gave on these other properties, so yours must be similar, and here's the value we gave you and why. If you feel that your property is different from those listed in the assessment rolls, you may file for the appeals, and then a governing body of the assessment that's different by district will determine whether they should review your case or not. And if they go through and review your case, you may have an equivocation or equalization board that will go through and make sure that your assessment is done correctly. The assessment appraisals must be done the same for all properties within a district. An appraiser cannot be simply mean to your property and give you a higher value because they don't like you. Okay, that's not how it works. And they know this, so they just won't go through with it because you'll simply file for an appeal of the assessment. And you can also do this on your car if you would like. That's pretty common as well. But the large one is property taxes. However, appealing your assessment is becoming more and more difficult, particularly as we move to digital electronic systems of appraisal and assessment, which will more or less make sure that the values are updated more frequently over time and lead to less jumps in the bill. However, that also means that your bill will also increase every year as we more frequently update the value of the properties. When you sell your property, you will end up paying a tax on that sale, typically in the form of income taxes. And this tax on sale may be taxed to you based on the federal, state, and local level, not just at the federal level or the state level, but also at your city can charge a tax on the sale of your property. The first step in calculating this tax, and you don't really need to know how to do this, but it's good to know the general idea so you don't have to know the specific details. We can leave those to tax accountants. But the idea here is you're going to find the tax basis of the item, in this case, the property that you're trying to sell. The tax basis of that property is what did you sell it for most recently, and what did you pay for it, plus any additional cost modifications. So let's say you bought a property for $150,000 and then you put on a deck for another $20,000. Well, at cost of your deck being $20,000, you add on $20,000 to the $150,000, your new basis is $170,000. Even if your house would now sell for $180,000, because you added the deck, your basis is not $180,000, it is still only $170,000. So that was, again, the price of the house you originally purchased at cost, plus the cost of your new adjustments and modifications, if there are any. Then, if you sell the property and there's any gain, you technically are supposed to incur a tax on the gain on sale, just as you would in any property. However, in the United States at least, there are exclusions for property for single individuals, $250,000, for joint married individuals, $500,000 exclusion on the gain on sale of the property. So you have $500,000 of exclusion of the gain on the sale of your property, which usually means you can sell your house for a large amount and still not pay property taxes. And this is usually only allowed on the primary residence property, not any secondary vacation homes or secondary, tertiary, etc. rental homes that you have. You can only use it on the primary residence in which you reside. But you can get away with not paying taxes on a large growth in the value of the property over time. So if you buy the property for $100,000 and you sell it for $600,000, you get to exclude the full $500,000 of gain on the property on your personal income statement and not actually pay taxes on it at all. So it's a pretty nice way of earning tax-free income or tax-free gains in investments. Interest paid on the mortgages is generally tax deductible depending on the value of the property, and it helps to offload the cost of those taxes paid on the sale of the property itself. Although there are some limitations on what you can deduct and what you can. One item that typically comes up is deducting interest on timeshares. Even though you are purchasing a deed in the timeshare, you may incur a mortgage. It is generally against IRS protocol and law to allow you to deduct interest on timeshare properties. They will not allow it. You may see it frequently, but you won't be allowed to use it again. Okay, Chapter 16 is titling an escrow closing. Title closing is where you're going to exchange not only pleasantries, but documentation from the seller to the buyer and payment from the buyer to the seller, documentation being the deeds. So during the closing event, there's going to be a few people there, sometimes lawyers along with agents, and then obviously the buyer and the seller. The buyer is going to want to bring a form of payment. The seller is going to want to bring the deed and the keys. So the seller has to bring with them, under the title closing event on the closing date, a properly prepared deed, the most recent property tax payment, an insurance policy if that is dictated in the title transfer agreement, inspection reports, again if they're dictated in the title transfer agreement and if they exist, and any offset statements, which are statements that declare that there is a balance or tax lien which is held against the property, and so the property is not being transferred free and clear. Okay, so if they're not going to transfer the title free and clear, there are going to be some liens that remain on the title in the deed that's going to be transferred. We would need the offset statement to say, well, this is how much is going to be transferred in the agreement, offset by these liens which the seller will still owe or is going to now compensate the buyer immediately for their taking on those lien values. Okay, the buyer must step into the closing agreement with the appropriate settlement funds, any loan documents that were used to obtain the settlement funds, and they usually have to bring the agent and a check for that agent's commission. The seller is not usually the one who has to pay the agent. It's the buyer, so-called a buyer's agent, who's going to pay the agent for the closing of all the events here. The agent is also necessary to do proration of any costs which incur from the position where we're going to sell the property on the 15th of August, for example. And let's say that the seller has been incurring costs from the 1st of August up to the 15th of August. Well, when we actually sell the property on the 15th of August, the 30th of August is going to come due, and the buyer is going to have to pay for all of those costs, even though the seller is responsible for the first 15 days. So that's where prorating occurs, and we'll talk about that here in a second. If you instead decide to close the transaction in escrow, you will hire an escrow agent who is going to handle all of the exchanges between the buyer and the seller. So the seller is going to provide the deed and any of the other documents we just mentioned to the escrow agent, and the buyer is going to provide all of the loan documentation and the settlement funds to the escrow agent. The escrow agent will make sure everything checks out and then transfer all of that information and or funds to the appropriate parties. Once all of that is done, then the escrow agent will file the close of the account of escrow, and that will be the deal is struck and everything is good to go. However, the escrow agent will not transfer funds to the seller until all of the seller's promises have been met, i.e. inspections have been done, those checked out, the seller has made a properly clear deed transfer, they provided the deed, the buyer maybe has done a quick claim to make sure that the deed is in fact the seller's. Once all of that has done, then the escrow agent will provide cash flow to the seller, which closes the deal. Okay? If none of these are done and there's a delay in payment, then the buyer may be able to require that the seller lower the price of the house or provide otherwise compensation to the buyer for delaying in the closing due to not meeting their promises. Prorating at closing, as we mentioned before, the agent must use proration to determine the amount of items that have to be allocated to the buyer and how much goes to the seller. Some items that have to be included in the proration are hazard insurance, so insurance on the property in case that it should be burnt or destroyed during the closing of the accounts. You don't want to come into a closing agreement standing at the agent's office and finding out that the house is on fire and burning down. The buyer will not be happy that they have just closed on a property that is now burnt to the ground, and they didn't have time to get insurance on it. Insurance will remain under the seller of the property for the initial time period in which we're going to sell it, the first 30 days. The buyer will have to pay for that insurance, but the seller is going to have to prorate their 15 days worth. Any loan interest that is incurred by the seller on the property would again be paid by the buyer, but they have to prorate the first 15 days in order to meet the correct closing cost for the buyer to make sure that the seller pays their portion of the interest. Any rents to be collected from rentees of the property, which actually goes to the seller, not the buyer. The buyer, however, would collect rents on the next month's first for past rents, or the seller may have collected rents on the first of the month, which are due to the buyer who is closing on the 15th, and they get the last 15 days of it, because they now own the property. The seller would have to fork over 15 days of the rents, unless otherwise stated in the transfer of the agreement. Property taxes, which are owned by the seller, will maybe paid by the buyer, and which will have to be prorated by the agent, okay, based on how long the days are there. And also homeowners association dues will also have to be prorated based on the days of the proration date. All right, that pretty much covers the content for chapters 15 and 16. They're fairly short content there. In chapter 16, there's also information related to the Real Estate Settlement Procedures Act, RESPA. You should read that information for RESPA if you are looking to become a real estate agent. If you are not, that information is not really prevalent to you because it simply tells you what is the law surrounding how we're going to deal with closing events. If you're not going to become an agent, that law is not really necessary for you to know. But if you're going to become a real estate agent who's going to deal in the buying and selling of properties, you should read that section, although you will have to know it in great detail for your licensing exam. We will continue on next time with chapter 17 and 24.